What's up, traders, and welcome to another installment of the Market Barometrics macro analysis series. In today's video, we're going to be talking about the difference between fiscal and monetary policy. Now, both of these terms refer to actions by either the U.S. government or the Federal Reserve to influence the economy. Now, both of these entities have several tools at their disposal that they can use to influence the economy in several different ways. So let's dive in and learn a little bit more about fiscal and monetary policy. So we'll begin our discussion with fiscal policy. This just refers to actions taken by the U.S. government to influence the economy. It does this by way of legislation surrounding taxes and spending. So as far as the legislative branch of the U.S. government, the U.S. Congress is generally tasked with drafting new legislation around taxes and spending. In addition to that, from the executive branch of the government, you have the office of the president along with his band of economic advisors, as well as the Treasury Secretary that also have a hand in directing fiscal policy. Changing tax policies are going to influence the economy and the stock market in several ways. First of all, as it relates to individuals, it's going to affect the proportion of income that individuals are keeping, and thus the amount of funds that they're going to have available to them to either spend or save. And as far as companies are concerned, changing tax rates are going to affect their profitability, and in turn, the amount of funds that they're going to have available to either reinvest in their own growth or to redistribute to shareholders. As far as the spending portion of fiscal policy, this has to do with the U.S. government's allocation of its tax revenues. Generally, this refers to government programs aimed at doing things like building new facilities and investing in U.S. infrastructure. This has the effect of creating new jobs and stimulating the economy. So there are two main categories of fiscal policy, those being expansionary policy and contractionary policy. Expansionary policy just refers to government efforts to stimulate the economy. So examples of expansionary policy would be reducing taxes or increasing government spending. Contractionary policy, on the other hand, refers to government efforts to slow economic growth, usually in response to increased inflation. So examples of contractionary policy would be increased taxes or decreased government spending. So fiscal policy is directed by the United States government and has to do with taxes and government spending. Monetary policy is directed by the central bank here in the United States, which is the Federal Reserve. This entity operates independent of the United States government and is tasked with what's called the dual mandate, which basically just means that the Federal Reserve has two primary objectives. The first being price control, meaning that they want to make sure that inflation hovers around a 2% per year growth rate. And they're also tasked with maintaining maximum sustainable employment. So the Federal Reserve, or the Fed, uses the tools at its disposal in an effort to achieve the goals as laid out by the dual mandate. These tools include the setting of capital reserve requirements, which refers to the portion of total deposits that a bank is required to keep on hand. It also sets the discount rate, which is the interest rate the Fed charges on short-term loans, and it engages in what are called open market operations, which is the buying and selling of U.S. government bonds. Now, each of these tools has an effect on either the money supply, which refers to the level of money in circulation in the United States, or the availability and attractiveness of credit to individuals and businesses, meaning essentially how easy and expensive is it to borrow money. So when you hear the phrase accommodative monetary policy or easy money policies, this just refers to the Fed using one of these three tools to either increase the money supply or make it cheaper for individuals and businesses to borrow money. So to put this all in the context of current events, when you hear the phrase fiscal stimulus, that's referring to U.S. government efforts to support the economy by way of reduced taxes or increased spending. In particular, individuals here in the United States have recently received stimulus checks. In essence, that's just a government spending program that's designed to support the economy by literally putting cash back in the hands of individuals, in hopes that those individuals will turn around and spend that money, which will support U.S. businesses and in turn support the U.S. economy. There's also recently been monetary stimulus efforts by the Fed. The Fed has used all three tools at its disposal to try to support the economy. First of all, they've lowered the capital reserve requirements, which has the effect of increasing the amount of money that banks have available to lend out to individuals and businesses. They have also reduced the discount rate to next to zero, which has the effect of lowering prevailing interest rates and making it cheaper for individuals and businesses to borrow money. Lastly, they've been engaging in open market operations by buying U.S. treasuries. This increases the money supply and injects cash back into the economy. So to recap, fiscal policy is directed by the U.S. government and refers to its actions to influence the economy by way of taxes and government spending. Monetary policy, on the other hand, refers to actions by the U.S. Central Bank, the Federal Reserve, or the Fed. Now, the Fed has several tools at its disposal that allow it to influence prevailing interest rates and to affect the supply of money and credit available in the United States. Having a baseline understanding of the tools available to the government and to the Fed is going to help us to determine how their actions are likely to influence the economy and the stock market. So if you guys like this video, subscribe to our channel, hit that like button, leave your comments down below. Check out some more of our educational material over at marketbarometrics.com. And for now, thanks for tuning in. We'll see you guys in the next video.